This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest edition of the AJ Bell Money Markets podcast. My name is Dan Coatsworth, and joining me this week is Charlene Young. Hi there, Charlene.
Hi, Dan. Oh, it's so good to be back, isn't it?
Yes, it's very good to have you back. It feels like we've finally drawn a line under the summer, and it's all back into the normal routine for the podcast. So, on this week's show, we're going to look at changes to the state pension and what might happen to capital gains tax at next month's budget.
Yeah, and we'll discuss some of the latest economic news and what it means for markets, including US jobs data and UK GDP.
Now, Apple has unveiled a new version of its iPhone, and I've got some interesting statistics on how its share price has behaved in the past when previous versions of the phone were announced.
We've got two guests later in the show. Stuart Widdowson from Odyssean Investment Trust will be joining us to talk about investing in smaller companies, and we'll also have the second part of our interview with Finsbury Growth and Income Fund Manager Nick Train. First up, though, let's talk about some of the big company news over the past week.
Yeah, we had a couple of takeovers. One involving a name that I think most people listening to this podcast should know. It's the property portal Rightmove. So it sort of suffered from a weak share price for a couple of years now. People have been a bit worried about what's happening with the UK property market, and then one of its competitors was taken over by an American company, and there's a fear that now this competitor is going to sort of pump loads of money and sort of try and increase its position in the UK market. So there's a bit of a sort of a lull for its share price. So that's resulted in Australian business called REA come along and essentially make an opportunistic takeover proposal. It's proposing to pay £5.6 billion to buy Rightmove, which works out at 27% above the price of its shares on the night before this news came out. So this is what's known as a bid premium. So it's the extra a company is prepared to pay to buy someone versus what its market value was. And so I think lots of people will not be surprised that Rightmove has come out and said, no, thank you, that's far too low. That significantly undervalues us. So there's been lots of suggestions. Okay, well, fair enough. Okay, what is the right price to buy Rightmove? And so I've seen some suggestions of 50 or 60% bid premium that is needed to secure that deal. So that one's a sort of very, very much a live issue at the moment. We haven't had REA come back and say it will offer more, but definitely one to watch. And the other sort of big takeover for me, caught my interest is the gold producer Centamin, which has got this absolutely gigantic project in Egypt. And we've got Anglo Gold Ashanti's come along and said it will pay $2.5 billion to own the company. And that probably looks like it will just go through. And it's a bit of a shame, really, because it just essentially will mean the London Stock Exchange will lose yet another one of the sort of big mining companies. Over the years, the UK sort of had this reputation of having lots of choices that investors can make to own different parts of the mining world, and it is shrinking. And it is a bit of a shame, really. It just means that if someone wants to invest in one of the big gold producers in the world, well, they've got very limited choice now left on the UK market, and then they're probably going to have to look overseas for opportunities.
Thanks, Dan. And so what's been happening on broader markets over the past week? We had quite a lot of economic news, and that can obviously influence share prices up and down.
Well, it's fair to say that the economic data that's come out isn't exactly amazing. There was some perhaps reassuring some stuff, but overall, they're not great. But the stock markets haven't really reacted wildly to them because I think everyone was expecting it. So first of all, we had UK GDP. Now, so the forecasts were a very small amount of growth. Unfortunately, we got no growth in July. That's the second month in a row that we've had essentially flat line. Now, see, it brought the pound down slightly. That gave a little bump to the FTSE 100 because lots of its companies earn overseas and they would benefit from a slightly weaker pound. But also, it it just reiterated the sort of the belief that, there's plenty of evidence here that the Bank of England will have to cut rates again. That gave a little boost to interest rate sensitive stocks like house builders and retailers. But overall, it just means that we're going to go into the budget next month, and the new Labour government is going to be saying, we've inherited a terrible situation in public finances, and essentially they've also inherited like an economy that's stuck. So even more pressure on them to try and get things moving. But perhaps for markets, what's going on in the US has a sort of a broader impact for essentially global stock markets. We've had weaker than expected jobs data. Then we had information that showed that the rate of inflation is slowing in the US. So I guess weaker jobs data is not good. Inflation slowing is what people want. So it's a little good, a little bad here. But I think what this means is next week we're going to get news about what the Federal Reserve will do with interest rate cuts. And rather than having sort of a dramatic 50 basis point or half a percentage point cut in rates, we might only get like a 25 basis point one. But everyone is expecting it to happen. And I think that if we get anything else, i.e. a bigger cut than expected or nothing at all, that's more likely to have an impact on stock markets than simply if we just get that 25 basis point cut. I think it'll just be, that's exactly what people expected. And you probably won't see too much turmoil, but who knows? You never know with these things. And of course, we're not really in the game to sort of trying to be predicting what will happen next on stock market. It's just what we think might come along.
Yeah, like you say, it's all kind of like what expectations are baked in, and sort of sounds like everyone's gaze has moved from the telescreen and that debate to what the Fed is going to do. So also, I noticed a little bit of drama involving a company called Hostmore. Now, listeners might not know the company's name, but they should be familiar with one of its big trading brands, and we've actually mentioned them on the pod before.
Yeah, so they are the parent company of TGI Fridays in the UK. So what happened was their share price fell by 90%, 90, in a single day. Now, we don't see movements like that very often. That's extremely rare. And as you might expect, there's some bad news. Essentially, the parent company of TGI Fridays in Britain is on the brink of collapse because it was trying to buy the American owner of the restaurant brand, but that deal has now fallen apart because essentially there's been a management change, which means it's no longer able to collect royalties from the brand. And of course, without that sort of cash flow, you have to question, is it really worth owning that business? So Hostmore obviously is in the process of selling UK restaurants, but is now saying it's not going to recover any meaningful value. So the PLC business looks like it's going to be wound up. So essentially, if you own shares in Hostmore, the 90% drop in that price is the market saying essentially this business is no longer worth anything or barely anything. So it's not really a good situation. I think we did talk about when it made the first announcement that it wanted to buy the American business, we sort of questioned on the podcast to say, who on earth still goes to TGI Fridays? And so this is the point, Charlene, that you say that you spent the summer enjoying all their burgers and onion rings or whatever.
No, I haven't. And that's the thing. I mean, I think I mentioned then there was one opposite the gym, and I had nipped in there sort of with the kids once or twice. But yeah, it used to be quite a nostalgic place to go when I was little. It was quite a big deal. Go to TGI Fridays. It felt like a real treat. And I think people's tastes and things have changed, haven't they? And perhaps it just sort of haven't, like you say, kept with the times.
Yeah, so the brand, you'll still be able, if you're a fan of it, you'll still be able to go. Just because the company on the stock market that currently owns the UK operations is essentially being wound up. These restaurants will still be trading. They will, under a new owner. So I guess that's good news if you're one of the few people that do like it. Yeah. So let's
good news for anyone who's working there as well. I think it's important to.
Oh yeah, absolutely.
Someone as well.
So let's move on to some pension stuff. So we're in the middle of this thing called National Pensions Awareness Week. So you might have thought, okay, why is it I'm reading lots about pensions this week? It's because there's a bit of a sort of a push this time every year to talk about what's going on. And actually, there's a bit of good news for people in retirement because the state pension is about to go up in value. So Charlene, tell us all the details.
Yes, so we've had the September inflation figures announced, which actually impact the state pension increase for people from April 2025. So there's lots of talk over recent months and years about the triple lock, but for anybody who's not familiar with it, it ensures that the state pension rises by the highest of three measures. So either the rate of inflation, the rate of wage growth, or an underpin of 2.5% each year. So whichever is the highest out of those. And the reason we wait for these September figures is that's the measure that's used for next April. It's quite common along how other benefits and other systems are rated. So the full, what we call new state pension, so for those people who have reached state pension age since 2016, that's set to rise by £460 from April next year to £11,962 a year. And that is because wage growth has come in at 4%. So that was the highest of those three measures. Now, people will notice that, we're just below £12,000 here. We're edging ever closer to that personal allowance threshold. Good. Now, there are groups that might miss out on the full 4% on all of their state pension. And that might be people who are under the older system. So they reach state pension age before April 2016, and they might receive the old basic state pension and an earnings element. Now, this element sometimes is called SERPs or additional state pension. It's still going to be uprated with inflation, which came in at 2.2% under the measure that's used here. But it doesn't benefit from that full kind of protection of the triple lock and the extra potential boost if earnings growth outstrips price growth like it did to September this year. There's also another group, who retire abroad, and some of those people do miss out on the uplift. If you move to a country in the European Economic Area, the EEA, or a select list that's on the government gov.co.uk website, you do get the uplift, whereas in other countries you don't. So places like Canada and New Zealand that are quite popular with people who retire aren't actually included. So it's worth checking out that list and checking whether that uplift will apply to you or any change of plans.
So I guess you could say this is 400 odd quid is pretty. It should be welcomed by lots of people, particularly if you qualify for the full amount. But actually, whilst we're talking about pensions, I thought there's another bit of news which was probably just worth touching on. Now, while it's just a suggestion at the moment, there are some sort of potential changes, being proposed to the amount of money that you can take out of a personal pension without paying tax. So, Charlene, what's the argument here?
Yes. So I have to be careful here because those of us who work in pensions sometimes roll our eyes when we hear stories like this because they seem to come around sort of once or twice a year, and we think, oh, not again. But we have to address it because these rumours do affect people and they make people worry about their sort of long-term retirement plans, as do other kind of rumours about changes to pensions. Now, the stories come out kind of reiterating the views of the IFS, the Institute for Fiscal Studies, who believe that the current rates of current maximum limit of tax-free cash when people access their pensions is, in their words, hard to justify. So at the moment, savers can withdraw 25% of their pension tax-free when they come to access it, and that's up to a kind of ceiling limit called the lump sum allowance, which is £268,275. And while the IFS believes that kind of monetary limit should be reduced to just £100,000. This isn't massively new from them. They have sort of talked about moves like this in the past, and their view is that this tax-free cash amount should be capped rather than any changes to kind of tax relief. Our view is that the tax-free cash amount is like a really important bedrock and an incentive for people to make their own provision in retirement. Crucially, it's kind of the part that people understand the most. I think people think, oh yeah, my tax-free cash, whatever they plan to do with it, it's in the world of pensions where we're full of jargon, we're full of misconceptions, the tax-free cash is kind of, like I say, that bedrock, and people understand. So any move to even consider kind of cutting this back would really kind of undermine savers, confidence in pensions, and it would be deeply, deeply unpopular. And I think it would really undermine like kind of government efforts to boost long-term investing, including, that huge kind of target to get UK PLC fired up and going again. It would also be really complicated to implement because would you protect people who'd already built up pots thinking that this tax-free cash amount would be the amount, the 25% limited to, the 268,000? Do you protect them, or do you draw a line in the sand? It's natural that we're going to have rumours like this when the government is continuing to remind us of difficult decisions and £22 billion black holes. But, our view is not to undermine this kind of sacred part of pension savings. And in reality, is it going to happen? I don't think so.
Yeah, I guess we'll keep you updated on any sort of developments in that area. So thanks, Charlene, for running through that. So it's now time to hear the second part of our interview with Finsbury Growth and Income Fund Manager Nick Train.
So last week, Nick talked about individual stocks such as Burberry. In the second part, we'll now hear his thoughts on the general market, his trust's performance, and a fascinating insight into Unilever. Hope you enjoy it.
So, Nick, I just wanted to ask you your sort of thoughts about just the general stock market behaviour over the summer. We had a bit of a wobble. It seems to have bounced back, particularly in the US. I know obviously you're predominantly focused on the UK market, but what sort of your general view? You think sentiment is pretty good across the board for investors, or are you slightly nervous about what might be coming around the corner?
I'm always optimistic about the outlook for sound common stocks. And I think the likely environment for global equities and UK equities within that, and you're quite right, that is my main area of focus. I think that the outlook is encouraging. Not just because probably the next substantive move in interest rates is down. I feel very hesitant about saying that because I've no real idea. But looking at what's happening to inflation and consumer confidence around the world, it looks more like the rates will be going down rather than up. But I think more generally, and this has been true of the last quarter of a century, that almost every industry you look at, almost every business that you look at, industries and companies are finding new ways to exploit technology that's leading to improved efficiencies within the businesses and enhanced products and services for customers. And that just seems like a constructive backdrop with which to be investing in markets, that there's a big, almost certainly multi-decade technology change that's throwing up lots and lots of opportunities. I don't want to, in fact, I wouldn't at all say that wobble in early August was a big warning signal. But I do think, investors do need to be cognizant of how returns from, let's say, a benchmark like NASDAQ are delivered. They tend to be delivered in a big surge, and you run the risk of losing some of that in a hurry as well. So I think tempering that with an acknowledgement that animal spirits can get out of hand at times with those tech stocks, that's worth considering as well.
So what's your thoughts about Finsbury Growth and Income's performance over the past 12 months? Essentially, it's a flat performance versus about a 12% gain from the FTSE All Share. So I guess whilst you've not lost money for investors, you've lagged the broader UK market. Is this a frustration to you?
Oh, it's a profound frustration and disappointment to me. Yeah. It's not because everything's gone sideways in the portfolio. What's so frustrating is that there have been big winners in Finsbury over the last 12 months, but I've had some big losers as well, and it's washed out to a flat return.
One of the stocks which perhaps it's been in your portfolio for a long time is frustration for many investors for quite a while, seems to now be on the move upwards, is Unilever. Are you sort of a bit more positive about where things are going there? Change in management, proposal to split out the ice cream business. You think is it traveling in the right direction?
Over the last 12 months, Unilever has been one of the bright spots in the portfolio. It wasn't for a couple of years prior to that, but the improvement in Unilever's business performance and share price performance, probably, you can look back now 12, 15 months and see some kind of turnaround there. What I think about Unilever is it's important to put the company in the context of its history. I mean, this is a very, very long established company with a multi decade history. And I think when you look back over Unilever over 20 years, 30, 40 years, has delivered a total return to its owners of 10% per annum, which, that's dividends and capital growth combined. But 10% per annum over a decade, that's not to be sniffed at. I mean, as it happens, that's rather better, notably better than the return on the UK stock market. It's not as good as the world equity market. It's not as good as NASDAQ, but nonetheless, it sort of makes sense to me, given the type of business that Unilever is, predictable, kind of, globally ubiquitous branded business, never going to grow very quickly, but just making steady progress. You look over the 10-year numbers, and absolutely that's what Unilever has done. Since the start of the century, nearly 25 years ago, I think Unilever's done about 12% per annum total return. So to me, it's all part of, what this company is. It's a consumer-facing company that generates significant cash flows. And if it wisely reinvests those cash flows in developing new brands, new products, then it has a chance to deliver predictable returns over time. And I see no reason why that shouldn't continue.
That was Nick Train from Finsbury Growth and Income Trust.
Shall we talk about capital gains tax? Because the papers have been full of speculation over what might happen at the budget next month. I was sort of reading about a rush of people selling their sort of second homes, or holiday homes in places like Cornwall, but it's on a much broader basis. It's definitely a hot topic, isn't it?
It has, yeah. So kind of having ruled out increases to taxes on working people, capital gains tax feels like an obvious place for the government to maybe make changes, or it certainly brought it into the kind of speculation headlines, if you like. So the most radical option, or rumour, I should say, is equalising the main rates of CGT with income tax. I mean, that would obviously represent a huge tax increase for investors. And we've seen that annual exempt amount, tax-free amount that you can make in gains slashed over the past 2 years. But again, does that difficult decisions rhetoric also include further tax increases to CGT? Now, reform here has already actually begun with a change to how earnings and bonus of private equity managers are treated. So There was a call for evidence in the summer, and it closed at the end of August, about how to move something called carried interest from being taxed as a capital gain, as it is at the moment at 28%, to salary income. So Labour hoped that this move would raise £500 million by 2028 if it comes in. And as I say, we're kind of being quick off the mark with this one. We've had a call for evidence that's closed already. And the obvious reason for it being already in motion is that it was a key manifesto pledge. But for me, does the fact that carried interest being singled out, does that mean that maybe a wider move to bring the main rates of CGT all the way up to the rates of income tax is actually less likely? Or do we think that other areas are going to be picked up and singled out? As you said, second homeowners seem to think so. Only we've seen a lot about the difficulties of being a landlord as well. So it's hard to know exactly kind of what's driving this behaviour. Is it the CGT part? Is that the last straw, if you like, for some of these people? Now, obviously, I need to stress these are just me going through my own thoughts here and rumours. I don't know any more than anyone else about what is going in that kind of big red box next month. And I think upping the main rates, we've seen conflicting figures. It might not be the cash cow the government or many who are speculating about it think it is. So the government's own figures showed that a big increase in CGT rates could actually backfire and lead to lost revenue. So one figure that jumped out for us was, if they raised both the lower and higher CGT rates for investments, sort of non-property investments, by 10 percentage points to 20% and 30% respectively, that would actually result in a total loss of just over 2 billion for the Exchequer by 27-28. And that's because obviously while rates are higher, investors might change their behaviour. You might just hold on to those gains. You might have been thinking about selling, and then obviously an extra 10 percentage points of tax might just make you hold on to that investment or asset if you can do so. Again, some of the other kind of rumours we've seen in terms of different areas of CGT being picked up or singled out is getting rid of tax breaks for businesses. So business asset disposal relief, where business owners sell their company. They actually, in certain circumstances, can benefit from a lower rate of CGT. It used to be called entrepreneurs relief, which I think is a name that kind of explains what it does a little bit better. Raising that rate from 10% to 20% to equalise it with the kind of standard CGT rates at the moment could generate 700 million for the government, but it's clearly a move that wouldn't be popular with entrepreneurs and small business owners and people thinking about starting a business. And again, kind of undermining that kind of boost that the government wants to UK PLC. The last point I'll make on this is there's a lot of talk about what's known as the CGT uplift on death. So when somebody dies and they leave some investments or assets to a person, that person inherits them at the value at the date of death. So if there was sort of inbuilt gains for the original owner who passed away, that's kind of wiped out. Now, if the government moves to scrap this tax break, it sounds easy to do on paper. It isn't. There would need to be some kind of allowance made for inflation. So the old kind of indexation rules that we saw with CGT rules in the past. Otherwise, if people who'd owned investments and assets for a long time, their beneficiaries would be really punished. So it's just the rumour mill, but it's just a kind of rundown of what might happen.
Because I think that it's quite easy for people to say, the government's going to change the tax system here, there, and everywhere sort of thing. But actually, you make an interesting point about potentially it could backfire and lead to a lower tax revenue for the government. And of course, I think that they're very aware of that risk, and because they don't want to be seen as like this budget coming up to be seen to be in sort of 12 months' time you rushed into that. Why didn't you give it proper thought? Because we've already got the oil and gas industry saying, well, if you boost our windfall tax, then we're just going to stop investing, and then you're going to get less money in a couple of years' time from tax on things. So I think that they're under pressure. Clearly, there's not long to go, but it's they will be thinking about what could go wrong if they do change tax system, as well as what could go right for their sort of the public purse. So for any listeners who aren't sure of the details, the budget will happen on the 30th of October, we'll do a special podcast immediately after the announcement is made, and we'll try, make sense of what's going on. I fear that there's going to be a lot of stuff in there, and that will, normally we can deal with these things quite comfortably, but we might have the biggest list you've ever seen. So it might be that we need to do a couple of episodes of the podcast to properly analyze any changes. But so just if you weren't aware, we're just over a month away from potentially some really big changes for personal finance.
I mean, I might start praying for a damp squib, but like you say, we're within 50 days now, and there's sort of plenty of kite flying and things to come. But we'll be here with like the immediate reaction, like you say, and then it might be that we do kind of more in-depth analysis a day or two later. Yeah.
So I wanted to talk about Apple's new iPhone. I know that we're not obviously we're meant to be talking about money related stuff, but this is something that Apple products are something that a lot of people spend a lot of money on, and also obviously Apple is one of the most very, very popular shares on the stock market, so it is very relevant. Before I hear any listener sort of saying, what on earth have we has the podcast turned into? Are you a loyal Apple product buyer, Charlene?
Well, I don't know if you just heard my kind of big sigh. I didn't mean for it to be so loud. I am, and I can't help myself. I have an iPhone. Is it 13 Pro? I think not the big one, but it's supposed to have a better camera. But I mean, it's on its last legs. I'm sort of a loyal yet reluctant one at the same time. I don't know how many years that means I've had it now, but it doesn't last the day in charge. The headphone jack is broken. There's a scratch on the screen, but I'm like trying my best not to give in and go for the new one. But then I've heard, the 16 or whatever it is. And we all know, well, I don't know, maybe you're going to tell me how much it costs or remind me, because I've blanked it out, and I might change my mind.
It costs a lot of money. I don't know. But I think this is, if you look at sort of the stock market and the behavior of Apple shares, they were up 29% in 6 months ahead of this product launch. Now, that's investors essentially saying, we think this version of the iPhone could have a really big positive impact on the company's earnings. So don't forget that the stock market is all about pricing in what might happen in the future, not looking backwards and saying, okay, what's the company achieved? So we've had the launch of it. It's got some AI tools. They won't be immediately available to everyone who buys it around the world, only in certain countries. There's also going to be a button on the outside of the phone that you can press to take photos. I guess, yeah. So that's what I thought, Charlene. You've got a blog, a vlog. You're an influencer. You'd love that, wouldn't you?
Yeah, I know, but listen to me. I'm already getting hooked in.
So I mean, to me, on face value, that sounds quite interesting. We've had quite a few articles in the papers sort of saying, actually, these aren't game changers. So I guess this is, the reaction. Once we had the launch, the market just shrugged its shoulders and going, oh, okay. So I think that's more a case of that a lot of the potential good users already priced in the lead up to the event, not this reaction to it. But a colleague of mine has done some analysis to looking at previous iPhone launches and to see how does the share price perform for Apple before and after we get a new version of the iPhone. So on average, 3 months before the announcement, it goes up by 16.8%. So we've had nearly double that this time.
Yeah.
I think lots of people tend to get wind of that there's a new version of it coming out, or Apple might be teasing the market itself, saying get ready, we've got something really cool coming, and everyone's sort of going, okay, it must be the new version of the iPhone. But what's perhaps equally interesting is how does the share price perform after the announcement of a new iPhone? So over 6 months, on average, it goes up by 4.6%. So not really much, and you could potentially argue that's indicative of kind of a normal share price movement. But over 12 months after the announcement of a new iPhone, it goes up on average by 22.8%. So that's quite interesting. So that's long. That's essentially long enough to see how many units have been sold. Is it really a game changer for earnings for the company? Now, it's no guarantee it's going to follow this trend, but it is interesting to consider. And actually, of the 12 launches that this analysis that we did of the different variations of the iPhone, only 2 years out of those 12 launches did we see the share price fall after 12 months. So anyone who's sort of thinking that all the good news about the iPhone 16 is now already priced in, you might find those stats very interesting.
It is interesting. Thanks, Dan. I mean, I'm probably going to go and have a look at it now, aren't I? So we've got time for just one more segment on the podcast, and it's our second guest of the week. Dan recently caught up with Stuart Widdowson from Odyssean Investment Trust to talk about how he invests, some thoughts on takeover activity, and where he sees the new opportunities. Let's hear what Stuart had to say.
So, Stuart, it's been about nearly a year since we've seen small cap stocks start to really pick up, sort of a different mindset from investors, sort of a bit more interest, a bit more risk taking. What's your sort of take on the current state of the market for small caps?
Look, I think if we were having this conversation in May, I would have been probably a bit more optimistic than I am now. I think you saw decent flows coming into mid-cap passive funds actually in April and May, very substantial actual inflows into those products. And there was generally quite a lot of optimism around. I think the early election created some uncertainty, and I think that uncertainty is now sort of percolated across the summer. So I think the market's in a bit of a wait and see mode again. There are questions around what's going to happen in the budget and how that might impact AIM stocks. In fact, I had a broker call me up this morning, quite concerned about what changes might, that might transpire. So I think we're in yet another piece of a period of uncertainty. Having said that, however you look at it, the UK equities still remain pretty attractively rated, and even so more down at the small cap end. I think it yet again possibly pushes out the inflection point of things starting to re-rate.
Yeah, I mean, obviously the market has been anticipating rate cuts from the Bank of England, and in the assumption that would be positive for the equity market. Do you think we've already seen the market price in a lot of interest rates cuts already? And the idea that once we see more cuts from the Bank of England, they might not actually push up the market at all.
Look, I think it's very difficult to call from. I was told by a client the other day, normally there's a lag impact from interest rate cuts feeding into small cap performance. But interestingly, the opposite has happened this year of UK small caps, where they started to move ahead of rate cuts. So look, I think particularly coming out of COVID and particularly coming out also of zero interest rates, I think we're in relatively uncharted territory. You would expect to see a little re-rating as interest rates get cut. But the big issue is actually where the new buy is going to come from for UK small mid-cap equities. And we haven't seen that yet.
So obviously one of the key themes that we've seen in the last couple of years is lots of takeover activity. Whilst the UK market in general might be unloved for a lot of people, there's still plenty of companies sort of spotting value. And one of the stocks in your portfolio that's had sort of takeover interest is XP Power, but it's fought it off. Now the share price is perhaps drifted a little bit since all that initial sort of takeover activity. But what's your thoughts on that business and the bid? Do you think it was right to sort of fight off that bid and say, I'm sorry, you're just simply not offering enough money?
Yeah, well, absolutely, Dan. I mean, it was one of the rare situations we went on the record saying that we didn't think the indicative offer from the closest trade peer really was reflective of the valuation of the company and the potential value we could get as shareholders over the short to medium term. So I think the board were right to be robust with the bidder. And the reason why is very, very simple. So that company is coming out of a difficult period of trading. If you look over the last 10 years, it's grown its sales organically on average at 10% per annum. And it's had a really, really tough 12 to 18 months. Its semiconductor business has found trading difficult as we're in this valley between, the previous cycle coming off and then growth coming through AI chips. That growth will start to recover next year, and it could be very explosive growth, actually. Then on top of that, they've had destocking in their industrial and healthcare clients, and this has all sort of come together as a perfect storm. So I think from a bidder's perspective, it's a great time to try and pick off the asset. But as we went on record, as a shareholder, why would you accept anything other than a knockout offer for the company now? Because in 12, 18 months' time, it might not just be trading at where that bid's come in, it might be a very substantial step higher. So again, we were supported by the board's action there.
Yeah. I mean, another stock that you had in portfolio, which actually did see the sort of a breakup and a takeover activity, was Essential. So obviously that's giving you some cash, and you also, the investment trust itself raised a little bit of money recently. So where are you sort of deploying this money that you've got?
So most of it's actually gone into new investments. It's our record. It's one of our biggest holdings now. We've invested in a company called Genus, which is an animal genetics business, an unusual one for us, and frankly one that I never thought we'd ever invest in. But it's the shares have actually performed very, very badly over the last 3 years, and we see it as a bit of a fallen star. We think it's a business with substantial barriers to entry, with market leading positions, where that strategic value is not really being valued by the market. And on top of that, actually, it's quite operationally geared business, and trading is at a low ebb at the moment. So, we think it's a classic investment for us to look at. Encouragingly, the chairman, chief exec, also agree with us. I think it was announced on Friday, the chairman's just bought £230,000 worth of shares, and the chief exec's bought £180,000 worth of shares. So, that's nice to see, with us having made the investment quite recently. The second investment is smaller, and it's actually an overseas company, a business that we've known of for a long time. And in fact, I was involved looking at buying a business off the founder 20 years ago or so. But hopefully that will grow in the portfolio, and we'll be able to talk about that a bit more another day.
And so you as a style, as an investment style, one of the things you like to do is sort of put your views across. I guess, would you call yourself an activist investor, or do you think you've just got sort of traits of that in terms of you like to engage rather than sort of lay demands on the table?
Yeah, that's right. I think we see ourselves as engaged investors, and with a small portfolio, we've got 16 stocks. We have the time to get to know our companies really, really well, and hopefully that puts us in a position to ask, better questions and really challenge in a constructive way, companies where we think that's necessary.
And so, could you give me an example of a company which you've invested in, and actually, they've listened to your suggestions, and actually that you've seen positive changes as a result?
Yeah, so a really good example was around Essential. Actually, we weren't engaged at the point of them, deciding to break up the business. But then the question became, how are you going to return capital? And I think the initial view was very much, let's just do a special dividend. And we said, well, actually, I think, we think quite a lot of people would like to stay in. Why can't you look at a mechanism where you do maybe some return of capital via dividend and then do a tender offer for the rest of it, which effectively allows people to not take all their money off the table and actually carry on if they want to. And that's ended up being, I think, a really good mechanism that served both existing or carrying on shareholders and departing shareholders pretty well.
What about the flip side? Have you ever sort of found yourself investing in a company and trying to engage with them, and then they're pushing back and saying, let us get on with it, stop interfering with what we're trying to do?
Yeah, so I think that doesn't really happen so much because we think very carefully about what we want to engage in. We want to try and find win-wins. So, look, one area where there's some debate is around investor relations. We believe, with flows very difficult in small mid caps, companies need to take ownership of their investor relations strategy. In the same way we do with the investment trust, we think about who we want our shareholders to be, not just today, but also tomorrow and the day after, and actually have a plan together to sort of, trying to attract the right long-term shareholders, rather than just be quite passive. Some companies see the value of that, other companies don't see it as much.
I mean, one of the things I found really interesting was I was looking through one of your presentations. Obviously, you mentioned with Genus, obviously you're investing when sentiment's quite weak, and I guess there's probably quite a few stocks in your portfolio where you think that they could do a lot better in the future. So, and there's some sort of margin targets in the presentation you've got. Some of them are double the current level. So, do you think that these, when you see one of your investee companies sort of give targets to say this is what we think margins could be over time, do you think these are credible, or do you think actually they're just being overly optimistic because they're trying to generate excitement in the stock to get investors on board because things might not be going very well in the business today?
Look, it's an excellent question. I think most fund managers are extremely skeptical. And what we tend to find, the benefits of the long-term capital we've got in the investment trust, we can take a long-term review. None of these companies are going to see these step-ups in margins in like 12 months. And what we tend to find is the marginal buyer won't price this in or won't get excited until he or she sees this being delivered. And that might be 2 years away. That for us creates a very good arbitrage opportunity if we can get comfort that these management targets are achievable. So it's interesting, since we've been going 6.5 years, we've looked back at all of the investments we've made, Dan, and we've not been great at forecasting sales, funny enough. But one thing is we have been really good at doing is spotting this margin uplift opportunity and backing those people that get there. And that's not by accident. We spend a ton of time not just looking at companies in the immediate peer group in the UK, but we look at their international peers. What margins do they make? So, XP's closest peer is quoted on NASDAQ. We benchmark margins against them. We also go and look back at what companies have achieved previously. So in reality, if nothing's changed in the business model and nothing's changed their markets, and you used to make 15% and you make 7% now, well, actually, with some better management, you probably should be able to just get back to where you were. So we spend a lot of our time in due diligence looking at this. And history suggests we are quite good at spotting it. It's very difficult to predict exactly when it comes through over a period of 3 or 4 years, though.
And so I guess if you're happy to sort of sit and wait for these things to happen, is there a danger that actually you're stuck with holdings that don't do anything for ages and ages and ages? And actually, at what point do you think, we've been waiting here for ages, should we keep waiting, or actually is it time to move on, sell them and just deploy our money in something where it gives us an opportunity and better, positive returns in a faster period?
Also, yeah, absolutely. I think the challenge with some of these companies is liquidity of the shares. So it's very, very difficult to predict each quarter or even each year which stock's going to perform for us. I wouldn't quite say it's random walk, but things happen and you don't anticipate it. I think if a management team is doing everything it should do to get to that long-term target, over 3 or 4 years, and the shares haven't done anything for the first year, that's a buying opportunity, right? It's not a reason to panic. If, however, they haven't done what we've expected them to do to drive that margin, they've not closed one of the factories, they've not put in a resourcing tool to help them improve their utilization from 60 to 80%. If they're not doing things to get them on that journey, then that's a reason to look at the investment thesis again.
That was Stuart Widdowson from the Odyssean Investment Trust. And that's all we have time for this week. Don't miss next week's show, where Dan will be talking to Mark Costar from JOHCM about some of the UK's best known companies. Until then, thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.